Well, great. You've finally made it to derivatives, everybody's favorite topic area. So let's jump into that and maybe start out by defining a derivative. Derivative is a security that derives its value from the price of another security, another asset, or an interest rate. Now, futures and some options are traded on organized exchanges. The other derivatives we'll discuss, forward contracts, swaps, and credit derivatives, and some options are custom instruments, and these are created by dealers rather than being traded on an exchange. And we'll highlight some of these differences, especially between forward and futures contracts, as we move through the material here. Now, we want to make a distinction between forward commitments and contingent claims. So our futures contracts, our forward contracts, and swaps are all forward commitments. It means you've contracted to do something for sure in the future. But options and credit derivatives we call contingent claims because your obligation depends on an event. So with credit derivatives, that would be a credit event, a default, or a downgrade by the borrower. With options, it's exercised by the holder, and that's going to depend on the price of the underlying asset. So learning outcome statement says you're not supposed to know the difference between forward commitments and contingent claims, and that's it. So let's talk about some of the details of forward contracts, right? Forward contracts, you typically promise to buy or sell something in the future at a specific price, and you're obligated to do it. Okay? If the price goes up and you're a buyer, you win. If the price goes down and you promise to sell at a given price, you win, and you can lose on the other side. So, specified underlying asset could be a currency, could be 100,000 euros, could be a stock, 100 shares of stock, it could be a value based on a price index or a bond. And so there's a specified date in the future at which you've contracted to either buy or sell, and the other side of the contract is committed themselves to take the other side of that trade. So the long gains if the asset price is above the forward price. Let's be clear about this. If I promise to buy wheat at $6 a bushel in December and the price goes up, then I have gains. Because wheat in December higher than $6 a bushel, I have the right to buy it at $6, so I gain by the amount of that difference times the number of bushels covered in the contract. On the other hand, the short gains if the asset price is below the forward price. So if I promise to sell wheat in December at 6 and price goes down to 4, well, market price for wheat is 4 and I get to sell it at 6. So again, I gain by that difference. So we've locked in a forward price either to buy or to sell. We'll say that the long position in the forward contract is the side that's agreed to buy the underlying asset, financial or physical asset. And the short position, the other side of that trade, has agreed to sell, both at the same price. Now, neither party pays at contract initiation. Later on in this study session, we'll get into the pricing and valuation of these derivatives, but typically the price is set so that at the time they enter into the contract, it doesn't have value to either party. And so that's why there's no money paid at contract initiation. And importantly, there's often no margin requirement, no requirement of any kind of a deposit. This is just based on the creditworthiness of each side of the trade, each party to the trade. Now, we can have a deliverable forward contract in which you've promised to deliver the goods, the asset, the securities, whatever it is, at the specified price. However, some of these forward contracts are cash settlement. That means, go back to the wheat example, we take the difference between the price you promised to buy at, and if the price is higher than that, take that difference times the number of contracts, and that's what's credited to your account. So the gains and losses are essentially the same. The difference being, instead of delivery, you just get the gains as if you had taken delivery and resold it at the market price, for example. Now, futures contracts, very similar. They are a promise to trade at the future date, to buy or sell. but they're standardized. And because they're standardized, they can be exchange traded. They're all uniform contracts, same date, same quantities, everything like this. And so that's an active secondary market. Now, with futures contracts, they do require a margin deposit. You're not paying for the contract, you're putting up a deposit that guarantees you'll perform. So if you have losses, as we'll see, they take it out of that deposit. If you have gains over the life of the contract, they're added to that. Okay. And with forward contracts, we have counterparty risk. The other party fails to perform under the contract, you may have some losses there because of that. With future contracts, we say there's no default and no counterparty risk. And this is because the Futures Clearing Corporation stands between those trades. So you go long, somebody else goes short, but your deal is not really with them. Your deal is with this Futures Clearing Corporation, and they guarantee each side of the trade. So that's why we say there's no counterparty risk with futures contracts, but with forward contracts there is. So some characteristics of these futures contracts. Well, the contract is going to specify the quality and the quantity of the good, the delivery time, the manner of delivery, and the delivery place if it's a deliverable contract. If you're delivering oil, you can't deliver it just anywhere. You need to deliver it to a storage facility. If you're delivering wheat, you need kind of a railroad car to get there and some place to store it when it gets there. So all of those are specified in the contract. So when we say they're uniform and standardized, if we have a contract for July wheat, they all have those same specifications. Now, as I mentioned, the clearinghouse holds the other side of each trade, so there's no counterparty risk. Margin is posted and marked to market daily. Now, when I spoke of adding the gains and subtracting the losses from your margin deposit, that's exactly what's going on with this mark to market. So if I have a long position in wheat at $5 and it goes up to $5.10, that is, not the spot price, but the futures price, the delivery price in the July contract or whatever it is. So if I have the long side and it goes up 10 cents, take 10 cents, contracts are 5,000 bushels apiece, multiply it by that, and you've made $500. And so that'll be credited to your margin account. In that case, the margin account of the other side of the trade, the seller, would have lost $500, and so $500 is taken from their deposit, their margin amount in the account. And so that's our daily mark to market. So this margin, it's not a loan, like when we talk about a margin transaction in stocks, we're borrowing some money. But that's not the case here. It's simply a deposit to guarantee performance. So here's some compare and contrast here, some points that are different between them so you can answer questions about these differences. So the forwards are private contracts. The futures are exchange-traded contracts. The forwards, each contract is unique. Some may be similar, but they're each written for the new buyer or seller. Futures contracts, as we said, are standardized and guaranteed by the clearinghouse. So we say we have default risk or counterparty risk with forwards, but we do not with futures. No margin deposit typically with forwards. That may be changing, but right now in the curriculum we're going to treat them that way. And little regulation of forward contracts. Whereas with futures, we know margins required, and they're fairly well regulated because they do trade on a public exchange. So the initial margin, that has to be deposited before the trade occurs. Now, that amount, if we've got, say, a 5,000 bushel contract on wheat, and it's at $4 a bushel, so what's that, $20,000 worth of wheat. Okay. Your margin deposit's not going to be that 20,000. It may be 1,000, it may be 800. It depends on the volatility of the contract. What they want in a margin deposit is enough to cover a few days' gains or losses. And so that's why we say these are leveraged positions. We're putting up a small proportion of the total contract size, just a portion of the $20,000, and yet the movement in the price is the movement in the value of 5,000 bushels of wheat to be delivered in July or September or whatever the contract specification is. Now, after you deposit that initial margin, remember, as the futures price moves, we either have gains or losses, and through this marking to market, that's reflected in our margin balance. Well, there's a minimum amount or a maintenance margin that must be maintained in a futures account. So, if this mark to market takes your margin balance down below the minimum or maintenance amount, then you need to deposit money and bring that back up, and I'll highlight this for you, back up to the initial margin. The reason I stress this is, remember, with stocks, if your margin balance fell below that minimum equity amount, you just had to bring it up to that minimum. This is different. Once you go below maintenance margin in a futures account, you must bring it back up to the initial margin. The settlement price at which this mark-to-market is done at the end of each trading day is not just the last trade. It's the average of trades during a closing period, a number of the final trades of the day. And this is used to calculate the margin. The reason for this is to smooth things out and not let one trade at the end of the day determine the price at which all the mark-to-market is done. So the settlement price is determined over what we'll just call the closing period of the day. Now, the spot price, we know that's the price for immediate delivery. Okay. Well, on the day the futures contract expires, the settlement price is the spot price. So futures prices, we say, converge to the spot price as futures contracts near expiration. And at expiration, well, the price of the futures contract says, okay, the price of wheat on July 21st. Well, come July 21st, the spot price is also the price of wheat on July 21st. So that's what we mean by they converge. They're the same thing at that point in time. Now, as we get these settlement prices every day, there's one thing that's different in the futures market, and that's the exchange imposes limits on how much the contract price can change each day. And the exchange members prohibited from executing trades at prices outside these limits. So we have a situation, there's some news, big bad weather in Brazil, the orange crop is hurt, orange juice futures start going up. Well, let's say that we were here with the futures price, and with the new news, the new equilibrium price is up here. Well, we may have limits that restrict it from going up there. In that case, at the end of the day, no one has traded, and the price has gone up the limit amount. That's what it'll show as the new settlement price, and that's what the mark-to-market calculations will be done with. And in that case, we say, well, no, there was no trading today. It was locked limit. The next day, maybe locked limit again, or it may trade at that new higher price if it's within that limit after 2 days. So why do they have those limits? Well, it smooths things out and also means that you're not going to get a huge requirement for additional margin on one day. And also, perhaps that new equilibrium price, as things settle out, maybe it won't be quite the movement it was in the first part of the day. So I think I've described this marking to market. We're going to adjust the amount in the margin account each day as the futures price changes. Now, the futures exchanges can require a mark to market more frequently under extraordinary circumstances. Well, extraordinary circumstances mean that it's so volatile that the amount of margin they have in there, they're just not comfortable with going a full day, and so that would be extraordinary circumstances, but they can change it if volatility increases, and they think that in order to protect each side of the trade and make sure the funds are on deposit, that mark to market more frequently than once a day is in order. Okay, we talked about futures, we talked about forwards, let's talk about swaps. We're not going to get into great detail with swaps here, but get the basics of it down and a little bit of terminology. We say they're equivalent to a series of forward contracts. They're custom instruments, they're dealer created, traded in the private market, not on any organized secondary market. They're largely unregulated, and default risk is a concern. There is counterparty risk, just as there is with forward contracts. Most participants are large institutions. It's not individuals entering into these swaps. And it's difficult to alter or terminate a swap. There's ways to do it, but the thinking is that the swap is going to be held until its final date, until its final settlement date. So some terminology for swaps. Notional principal, that's the amount used to calculate the payment. So we'll say, okay, this swap's notional principal is $10 million. Then if we have a floating rate, usually LIBOR, okay, could be other floating rates. Well, when that rate is determined, that determines the next interest payment, and that next interest payment is based on that percent of the notional principal. So we're talking about the interest on $10 million, if that's the notional principal. Tenor refers to the time period covered by the swap, and then we have the settlement dates, the payment due dates. May have quarterly settlement dates, semi-annual, annual, any of that, but they're all specified in advance under the contract. So let's just look at the simplest swap, a plain vanilla interest rate swap. One side agrees to make fixed interest payments. The other side agrees to make floating rate payments. So we got our $10 million notional principal. I promise to pay you 6 months LIBOR. You promise to pay me 6% annual with semi-annual settlement. So we've got settlement dates every 6 months on this. So come to the end of the first 6 months, well, those payments are already known because the first 6-month LIBOR and the fixed rate, which is known for the whole contract, we know what that's going to be. So let's look at a more interesting situation. What happens when we get to the first 6-month date? Okay. Well, whoever owes the most pays the difference. That's what we mean by saying that these interest payments are netted. So then 6 months out, it's then that we know 6-month LIBOR for the next 6 months. We know that we've got half a 6% or 3% payment on the fixed rate side. So then at the end of the year, the second settlement date, the payments are netted again. So who wins, who loses? Well, the person who is paying the fixed rate is going to have gains if the floating rate interest rates are higher than what is expected at the initiation of the contract. And the floating rate payer would end up having gains if floating rates went down so that those payments were less than expected at the time we went into the contract. Now we've got the option buyer and the option seller, and overall we'll say the option buyer is the owner and has the long position. The option seller is the writer of the option, and we also say has a short position. Now it gets a little bit confusing because we've got calls, which gives the buyer the right to buy the asset, but we also have puts, which give the put buyer the option to sell the asset at the price specified in the option. But just more generally, we can say that the option buyer pays a premium, that's the option price, to buy the right to exercise that option at a future date, and the option seller incurs the obligation because it's the long position, it's the option buyer who decides whether or not to exercise that option. If it's not exercised, expires worthless, it just goes away. So that's why we referred to these as contingent, okay, rather than forward commitments. So now let's get into a little more detail on puts and calls here. The call option says you have the right to purchase the underlying asset at the exercise price. That's also called the strike price. And the short side, the writer or seller of the call option, has the obligation to deliver the underlying asset at that exercise price. And puts are the other side of that. The long has the right to sell the underlying asset at the exercise price, and the short has the obligation to buy it at that price. Now, do they have the option to exercise it any time? Well, if they do, any time until the expiration of the contract, that's what we call an American or American-style option. And European-style options can only be exercised on the expiration date. No early exercise, no exercise prior to expiration. Now, don't get confused. This really doesn't have anything to do with where these options are traded, where they originated, or anything like that. This is just our terminology. American options can be exercised at any time prior to expiration. And because of this, we can look and say, well, American options must be worth at least as much as an otherwise identical European option. And think of it this way. The American option and the European option both give you the right to exercise at expiration. But the American option gives you something else. The American-style option gives you the option to exercise early. Now, that option to exercise early might be worth zero. In some situations, we'll describe it is. Well, in that case, the American and European style have the same value. But it can be the case that early exercise is advantageous. In that case, the option to exercise early has value, and the American option will be worth more than the European option because it gives you more rights. So that's why we say the American options are worth at least as much as a European-style option. One of the things we'll talk about with options is its moneyness. Is it in the money? Is it out of the money? Is it at the money? Well, when we look at an option, we're going to say it's in the money if the underlying asset price is greater than the exercise price. So if I have the right to buy 100 shares of Netflix at $600 and the price of Netflix goes above $600 in the spot market, then we'll say those call options are in the money. On the other hand, a put option is in the money if the asset price falls below the exercise price. So if I have the right to sell 100 Netflix shares at $600 and the price of Netflix shares falls to $560, then those put options are in the money. If they're in the money, you could look and say, well, if you exercised it right now, you would make a profit. So that's what we mean by in the money. And we use that same terminology, whether they're American-style options that can be exercised early or European options that can only be exercised on the expiration date of the option. We still use these moneyness terms in the same way. Now, what about credit derivatives? They're probably the most challenging of these. Credit derivatives provide a lender or a bondholder with protection against a credit event. So default by the borrower, it could be a downgrade in a rating. They can define the credit event however they like in the contract because these are customized contracts. With a credit default swap, the lender pays periodic cash flows to the protection seller and receives payment if credit event occurs, similar to insurance. Yes, really similar to insurance. I don't want to get into why they're called derivatives and not insurance, but let's go back to our top statement there. Provide the lender or bondholder with protection against a credit event. Well, it's like buying fire insurance on your house. In a credit default swap, you make payments periodically. If there's a credit event, you get paid. With your house insurance, you pay your fire insurance each month. When do you get paid? If there's a fire that damages the house. So very much like insurance, and we're insuring against a deterioration in credit of some sort. Now, there's a lot of structure and detail that goes into it, but that's really how you want to look at it overall. As we're making insurance payments each month, we get paid if the house burns down. So there's been some criticism of derivatives. They're often criticized as being risky or like gambling, something like this. And that's really not the case. They certainly can be risky, and they can be used to speculate. We don't call it gambling in finance and investments. We call it speculation. But certainly they can be used for that. But when you think about where futures came from, for example, they came from the commodity markets. If I'm a grower of wheat, I've got wheat price risk. When I harvest that wheat, I don't know what the price is going to be. So there's uncertainty about its value because the future price is uncertain. And as a grower of wheat, if the price is high when I harvest it, I make more money. If the price is low when I harvest it, I make less money. So that's the nature of my risk. Now, over here, you've got a bread company. They need to buy wheat all the time. Well, if the price of wheat goes up for them, that costs them money. And if the price goes down, that represents gains because they have lower expenses. So now we've got two parties that have risk. And they don't really want that risk. The farmer wants to grow wheat for a living, not speculate on the price of wheat. And the baker wants to make bread and not speculate or have to deal with pricing changes and things like that. They'd go along with fluctuations in the price of wheat. So why were these futures markets created? Well, to transfer risk at very low cost. They enter into a contract and the farmer says, you know, I promised to deliver 100,000 bushels of wheat on September 18th at this price. Well, now the wheat price risk is out of the situation. Farmer knows what he's going to get for at least 100,000 bushels of his wheat come September 16th. On the other side, we've got the bread maker who's taken the other side and promised to buy wheat September 16th at that same price. So now, no matter what the spot price is come September 16th, the baker knows what the price of their wheat is. So now, through a fairly low-cost transaction, two parties that had risky situations transferred the risk so that now neither of them has wheat price risk, at least on those bushels that are covered by the contract. So what's the role of arbitrage in all of this? Well, we'll hear some more about this in future readings in derivatives here. But when we say arbitrage is possible when two securities or portfolios have identical future payoffs but different market prices. So that's a fairly general statement, and it's certainly correct. We need to zero it down, focus it a little bit more to understand, I think. But we could have combinations of securities that have just the same payoff as another security. We can do those combinations. They could be trading in different markets. If we've got one security trading in this market and is also trading in this market, but the prices are different, then there's an opportunity, we say, for riskless arbitrage. Well, buy low, sell high. So you buy the lower priced one and you sell short the higher priced one. And because the payoff on your long position just covers your obligation on your short position, whatever difference there are in those prices when you initiate this arbitrage, that's your arbitrage profit. That's what you get to keep. So the idea and why it comes up here in derivatives is we say, well, trading by arbitrageurs will continue until they affect supply and demand enough to bring asset prices to their no arbitrage levels. Well, when we talk about derivatives pricing, the prices we're coming up with, we say, well, those are the no arbitrage prices. If there's no opportunities for riskless arbitrage, then the price must be here. And the argument is not you should look for these arbitrage opportunities. They'll probably be exploited by people that are active in the markets, brokers, commodity dealers, big users of commodities, big banks, things like this. But the argument is this arbitrage will go on, and it will go on rapidly and efficiently. And so our assumption going forward is that the prices of these derivatives in relation to the securities and assets that they concern are at their no arbitrage levels.